All right. Good morning, everybody. So today, the number one thing that we really got to watch for are these unemployment numbers. It's going to be jobs this week and next week. Anything to do with jobs, you're really going to want to keep your eye on. This is going to tie in very well with anything to do with the Fed and one more rate hike this year or not. There's been rate hikes around the world in other nations, and then like China doing a rate cut, Russia did a rate cut. So, depending on what part of the world we're looking at, they're easing or they're tightening. And in the US, a lot of analysts had said the Fed was done, and they just couldn't really say they were done, right? That's why they had that skip. Or it's also why they removed the forward guidance. They're no longer telling us in advance how many times they're going to raise or if they're going to pause or not. They removed that during the last FOMC. And when the minutes came out yesterday, it reinforced the idea that they're not all on the same page and that we might still see another rate hike this year. I believe it was Bank of America, but it might have been one of the other big firms that said they see one more hike this year. So there's not an agreement between the banks either on on if we're going to get one more. If we go to that FedWatch tool, CME group, this is a free tool. You can Google for it. Just start typing in CME FedWatch and you'll get it. You don't need an account. You don't need to log into anything. It'll tell you the anticipated FOMC dates and then the projected ones, the ones that aren't exactly set into stone yet, but we know it would be somewhere close to that date. And if you go to the September meeting and look at where we're at, just to kind of show you how to read this thing, we're currently sitting at 5.25 or 5.5. And the easiest way to read this is just to look at one number. It doesn't matter which number you look at, just look at one. So if we say that our current rate is 550, what's the projection for September? That we will still have 550. So this is saying the market has priced in a pause for September, no hike. Notice the dates, September 20, and then the next one is November 1. So for September, the consensus is no hike. We're going to stay. We're going to pause. And I said consensus, but this is actually based on trading volumes within the ZQ contract. So it's not like they went out and ran a survey and said, you think they're going to hike? What about you? You think they're going to hike? This isn't a survey consensus. This is looking at what was traded and what those trades represent. So looking at the contract ZQ and how it was traded, it seems the market is pricing in a pause, at least for September. If we come down to the lower portion, we can see how much that number has changed in one day or 1 week or 1 month. It's telling you where it was a month ago versus where it is now, or where it was yesterday versus where it is now, right? So now you got a pretty good idea how to read this thing, how to use it. You don't have to go out looking around on the web to get the stats and the numbers and what the market is pricing into to do during these FOMC events. You can just go get it for yourself, right? It's kind of the idea of these morning briefings, is to empower you, give you the tools, and send you out into the world to do damage on your own, right? So we got November here. And again, if we're using just one number, that 5.5, so far, the numbers represent they're going to pause in November. But there's not just one bank. There's a lot of analysts who say the Fed's got one more hike in them this year. So we want to see if the data that came out yesterday changed some of these numbers around. And if it changed anything around, what increased and what decreased. Going from 550 to 575, just a 25 basis point rate hike. That number went up marginally, went down marginally from 35 to 34. Getting a 50 basis point rate hike went up marginally. And staying the same, getting another pause, went up marginally. So it seems that's more than likely just some shifting around, because that doesn't really give us very clear information here. You know, past November, come into December, and now we can see they're looking at a 50 basis point rate cut with a 5% chance, holding the line at a 60% chance, and getting a 25 basis point rate hike at a 32% chance, with a 50 basis point rate hike at a 3.6% chance. The numbers really didn't change that much either from one day. What I would be interested in is how it looks by next Monday. You know, we got the FOMC minutes yesterday. Let them digest it a little bit. Let them go in and make the trades and the changes. And then let's see what this reflects. And the idea really is, are they going to price in one more rate hike or not? And if they start pricing in that rate hike, we're going to see equities continue to go down a little bit. That's kind of the idea. If they start pricing in a rate cut, we're going to see equities start to go up. But this is just one thing that the market is dealing with. Another thing is what's going on over in China. That's going to directly affect commodities. Commodities are directly going to affect inflation values and inflation numbers. And then you've got Japan. So we've got 3 different large issues that can affect the US markets that have nothing to do with what the candles look like on the chart, right? Daily, weekly candles, momentum, trend, moving averages, MACDs, stochastics, all that. Just take it and throw it in the trash, right? Because you won't see these things coming on that candle chart. All right, so we can see what's going on with Hong Kong. They did have that double bottom, a classic perfect double bottom where it went lower than the previous low, trapped the bears, and now has sprung back up the other direction. They're still inside day, right? They didn't get outside of yesterday's range to the upside yet, but they did get the inside day breakout to the downside. If we can run just a little higher, we'll get that engulfing candle down here. Looking at the FTSE 100 for Europe, got a strong indecision candle, inside day breakout to the downside, pretty clean recovery so far. Their markets are still open. It's 12:41 in London, so they've got a few hours left, right? We might see this turn around, but we've still got a larger pattern here, that double bottom setting up. So this range in crude, it's a really big deal. A lot of people are saying that crude is on the run and that it's actually going to stabilize, find some support, and continue that breakout, and that we're going to get back up into the 90s. That's a pretty bold statement, but it would tie into the higher commodity prices too. So it's certainly something to keep your eye on. I don't think this pattern is done. But for the moment, the trade is to the downside, whether you like it or not. You know, you got to play what you have, not what you think. And I don't see a reason to go long here until we can get above, say, 89 in Brent or 85 in crude. And you could use something like USO. It's going to have the same pattern. It might not have the same number on the side, but you can do it that way too, right? Just use something like USO. The takeaway is that this is kind of another part, right? We got Japan with the yield control situation. We got China with a massive slowdown, and you know, that whole debacle with real estate and the Evergrande, and it just, you know, that whole widening cesspool of trash. And we've got the Fed with its rates and whether or not it's going to do those rate cuts, and we've got energy starting to take off. Previous estimates on the job claims, or the previous job claims, was 248. Just remember, you want to go in and dig deeper. If these numbers are what you are really honing in on, make sure there wasn't revisions, because they're really famous for putting out a headline number, and then after everybody quits looking, they slip in a revision and adjust those numbers. It's dirty and shady, but that's just the way it is, right? So if those numbers really matter to you, dig deeper. Don't just use the number that you see where it says previous. But we're going to use that 248, and the forecast now is for jobless claims to have gone down to 240. That's the forecast, which does come from consensus. So they ask a bunch of people, hey, what do you think the numbers are going to be? And then they tally up all those answers and they get the mean or the average. So 240 is the group think number today. And I was listening to Bloomberg to see how cocky they were on that number, and they weren't, which is, for me, telling that they're not going to have too big of a surprise. Markets don't like surprises. That's generally where we get a big reaction to the market, is if they all think they know the number and start getting cocky about it, and then the number is off, we see those big moves trying to readjust because they're off sides. They weren't that cocky. So while today's numbers could be volatility inducing, I'm not expecting some big blowout move today due to those numbers. We can see on FX Street how the job numbers here are kind of in the middle. It's not crazy light and it's not dark heavy. So it has had an impact before, but the general idea is most of the time these numbers aren't going to be too volatility inducing. When it has been volatility inducing in the past, it's generally because they've been off sides and were really cocky about they know the numbers. No, they don't. We are getting some economic data out of Japan tonight, by the way. So, you know, really understand what's in your portfolio. Know what you own is the phrase, because, you know, we could be up or down 4% from where we close tomorrow by the time we come in tomorrow morning, based on these numbers that are going to come out of Japan. We also have additional auctions today, which we'll get into when we get over to Thinkorswim. Eight 8:30, 10 o'clock, 10:30, 11 o'clock, and 11:30. It's kind of a full house. Nearly all day today, we've got something going on. Although after 10:30, it's really just those additional auctions, right? So you got 11:30 and 11 o'clock for those additional auctions. Normally at lunchtime, we expect a lower volatility, right? We expect the market to kind of take a pause and a timeout. Today's different. When we get to 11 o'clock, anticipate volatility today. Anticipate volumes coming in and price making a move. When we get through to noon, you 0-day traders are free to go into the afternoon. There's no headline material coming out should be fine. All right, so looking at the overnight volumes, we are exactly where we should be, right around that 100 number. So not too light, not too heavy. And we can look back over the last, say, 2 weeks and see that we're right about where we should be. Right. Tuesday actually had some volumes of note, came in at around 147. But other than that, we've been running 85, 90, 100. It's not that bad. Right. It's interesting to note now that we're zoomed out a little bit looking at this, that the previous Tuesday was also sitting in the 140s. I continue to get more and more out of this overnight cumulative volume. And now got myself a little question that needs to be answered. What's going on Tuesdays in the overnight? I'm going to have to dig down and see if there's more to that. Either way, we're done with it for today because we're within the boundaries of what we were anticipating. We don't need it on there anymore. We've extended significantly away from the weekly pivot point. It's not the mean or the average or anything like that, but it is a demarcation, kind of a line in the sand. To me, it has weight and value behind it. And when we get too far away from it, start thinking about that overbought, oversold kind of language. It's not necessarily a good idea to use that kind of language. It gives you this mental map or implies that if we're overbought, maybe it should sell off, or if we're oversold, maybe it'll get bought up. But things can stay overbought for much longer than you anticipated, and they can stay oversold much longer than you anticipated. And in fact, those readings are often where a market is at its strongest to the downside or at its strongest to the upside, and that you wouldn't want to try to get in front of that freight train. Right. So when something is overbought, it is at its strongest bullish move. And until that starts to slow down or, decrease, you want to go with the move, not go against it. Having said that, we did extend significantly away from that weekly pivot point. Yesterday, we did end up closing on the day without touching the daily pivot point, which makes that a valid and fully confirmed missed daily pivot. I mentioned it yesterday. I basically mention it every time. If you don't understand the significance of a missed daily pivot, just go search for that on YouTube. You'll find the videos. And if you don't want to trade the strategy, I don't trade the strategy, you'll at least understand how you can use that for analysis and perspective on the market. Today, we also have a missed daily pivot, but I don't expect that to last. We've been kind of grinding our way up, and we've got a fairly wide head and shoulders, inverted, right? Left shoulder, head, right shoulder, neckline break. You would measure this distance and plot that distance upwards. I'm just eyeballing it here, saying we've made 50%, and that's really all that it owes us. So if you're sitting there this morning saying, oh, hey, look at that head and shoulders, we're bullish now, we can go long. No, it only owed you 50%, and it has given you that 50%. So the head and shoulders could be done at this point. It is possible that it can give you 100%. It's true, but it doesn't owe you 100%. It only owed you 50%, and we've got that 50%. We also, while we continue to see higher highs and higher lows here, the ROC, or the rate of change, is decreasing, and we're seeing a topping pattern after that last leg, kind of implying also that at the very least, this head and shoulders pattern is done. And just because it's done doesn't mean we're going to go down from here. It's not necessarily what I'm saying. I am stressing, though, that you can't look at that head and shoulders now and try to use that for your bullish bias because it's done. You have to have something else to use for your bullish bias. We can say that we're holding above VWAP and that every time we come down to VWAP, it's getting bid up. Okay, we know that the institutions will use and actually promise VWAP to their larger clients, right? It's been a selling point for many years now. A big firm wants to accumulate, in this case, a bunch of contracts. Firm says, okay, well, we'll guarantee you VWAP. So price comes down, they turn the algo on, it starts buying. When it gets too far away, the algo shuts off. And when price comes back down again, the algo kicks in and starts buying again. They're promising them VWAP within a certain boundary or a certain range of VWAP. It might be, you know, 0.1% or whatever. It's only going to fire for that long, and then it's going to stop again. Because if it just kept firing, it would just keep pushing price farther and farther away. It's going to continue to do this until that order gets filled, right? Or unless the market takes over and starts driving price higher, in which case they would just sit back and wait for price to come back to VWAP again. That's not new, right? That's been around for a couple decades at least. But when it first came out, you know, it was a huge selling point that they could offer that to their clients. When we see it in action, which we don't see it like this every day, is pretty clean. So it was worth mentioning. It can happen to the downside. It can happen to the upside. But until it's done, we're very likely going to continue to see that same fade, and that, you know, us retail just don't have the power individually to run this up. Retail certainly has the power to run it up if collectively we have a reason to buy it, but, you know, overnight, slow, not really a lot of action, no reason to bid it up. We're probably going to continue this move until the econ comes out at 8:30. There was some questions yesterday of, are we done yet? And, you know, it had a little bit of a wink to say capitulation, right? When it's TINA, TINA, there is no alternative. That's usually the flip spot, right? But I've got my own YouTube go-to, right? There's a few people that I go out and watch their videos. And when I was watching one yesterday, I was reminded to check a couple things. One of those things wasn't just the overnight cumulative volume like you see me look at every day, but it was also what's up with the daily volume. And kind of consider what you would expect when we get a good size sell-off. We can see that back here when we really started selling off in March. You see those elevated volumes. We can see it back here in November and December when we had those elevated volumes. Or back in September and October with the October lows, and still that high volume, +2, right? +2 million. We ain't even hitting 2, right? Where there isn't the volumes that we would expect. And there's no, the fear isn't there, right? The tape speed wasn't really wild and crazy yesterday. It was just very clean, controlled action. No panic in the streets, nothing like that. So was that TINA yesterday? Was, you know, the whole capitulation selling? I don't think so. And what I really wanted to see this morning was a good gap down and then the rally up, right? So we're just going to stay on this daily for a moment so that we can kind of pinpoint what some of those reversal rallies look like. You take it back to October, and we had a gap down and then a rally out. And on this one, it didn't gap down, but it certainly fell down and then the rally out. And it still stalled for a few days before it finally took off. We caught that move. If you were around last year, the morning briefing was, man, we're selling off hard. I bet we're going to go up, and pointed out all the reasons why I thought we were going to go up, mainly because of those bonds. And yeah, caught all of that. Doesn't matter. That was last time. This is this time. I don't think that this move is the one we're looking for. The volumes aren't there. And let's look at ZB for a moment. So we got this really wide double bottom, expands all the way back into last year. And so far this morning, they're not really coming in to fix anything. Until this turns around, we can't get that rally. Until this 10-year turns around, we can't get that rally. Right? So the bonds need to change up, and the 10-year needs to change down. Now, notice the difference. Bonds aren't yet to that 2022 low, but the 10-year yield is already at that 10-year or that 2-year high, right? Last year's high. So yields are leading, bonds are reacting. And this has to change, or we're not going to see the equities run back up, right? You're not going to see that move in the S&P and all the Magnificent Seven and all of that. You can't until this changes. All right, 10-day, 30-minute volume profile. When we're at the lows, we expect to go to the highs. When we're at the highs, we expect to go to the lows. We are at the lows. Point of control is a long ways off. We can still consider this a D shape, but due to that move to the downside, it's very likely that we're going to have a P shape like we do here on the TPO. So we just got, a bit of a long tail at the moment. There is a little bit of a shelf here underneath this, but I wouldn't count it for much. And it's pretty shallow, but as we try to rise, we've got a lot of resistance to work through. And that's not just these volumes, right? Think about gamma structure and the opportunity to sell things. So every time price tries to come up there, the big firms are sitting there happily selling out a lot of those calls they're still holding on to. So it's just this big ceiling or wall, right? Call wall resting up there. And this isn't really the format for it, but if you were to go over to like Trading Ticks or something like that and see where the call wall is now, look at where it was yesterday and or earlier in the week, and kind of be able to ask that question, are they rolling the call wall down, right? Because if the call wall was up here, and then a few days later they roll it down and then it's here and then it's here, is it down here now? because that becomes the new level of resistance that we very likely won't get through. And what most people look at is the snapshot today. They just go look at the number. Where's the call wall? 44.50. Oh, okay. Well, I know the call wall's at 44.50. But really follow it back a couple days and ask that question. Where was the call wall 4 days ago? 4,500. How about 5 days before that? 45.50, 46. Are they rolling it down or are they leaving it where it is? Provides a lot of information at that point. All right, we got the 5x5 here. So we got this old VPOC that we've had for a long time. It finally got hit in the overnight hours. I'm going to leave this one on through the day today and end up taking it off tomorrow, just because I want to see how intraday price responds at that level, if it does respond at that level. And we also have now a VPOC overhead to deal with. Just kind of ballpark it there. Doesn't have to be spot on perfect. So we got that VPOC. If we continue this drive to the upside, call it 44.60-ish is going to be a level of concern. Probably already have something in that area anyways. You've got the RTH open. That's going to be a major level to work through, 44.50. But again, that's if we can continue this drive to the upside, and that's a rising wedge. Rising wedges tend to break to the downside. So I'm going to leave this VPOC on until later today, but it is down there, 44.11. It's a cog line anyways. So even if we didn't have this VPOC, we'd still have that cog line. It's interesting to check this just really quick. We've got a lot of volume up here where we're at. And the question is, does it match with the amount of time that we've spent up there? Well, you can turn on TPO. That's reading way too far, right? We just need 1 day. And then we can answer that question, where's the greatest amount of time been spent since the 6 o'clock open? Well, we've spent the most time, or we had the most trades by time at 44.25. So they're not quite lined up, but we can see that the point of control is getting close to moving from where it is at 44.25 up to this other point of control. And that's because we're spending a lot of time here, right? That bar continues to expand. And if it expands enough, point of control is going to move up there. So I just used that to answer a question. Was there any significance? Did we hit a ceiling up here or anything like that? Nope, we didn't. So we just move on. Never mind. Nothing to see here. All right, we are more than 1% below the 10-day moving average. While it doesn't look too clean when it comes to this wave, we do have, a bit of a wave here, and we're on the downside of that wave. It's not the first time we had a false start where we got below the 10 and we either crossed back above it or got near it and then came back down again before making a move back up. Same thing happened here, right? It's happened before. So we got to just, ride it out. At this point, there's still nothing that is suggesting we're going to get this big, massive sell-off, right? It doesn't owe us a move like that. there's a lot of risks out there right now. Certainly we've touched on a couple of them. But we don't have it yet. We are really close. If you go to like stockcharts.com and listen to David Keller and a couple of the people that he's had on, we are really close to a make or break point in a lot of the Magnificent Seven names. And if tech does give way, there's very likely going to be a hard, sharp, fast sell-off. But I don't see that turning into a major issue like last year where we went down for half the year or more. All right, we're looking at the 9-grid sector. Just kind of get an idea of where we're at. The top 3 are risk on, the bottom 3 are risk off, and the 3 in the middle are the midline. Orange line is a 50-period moving average, and the purple line is a 200-period moving average. A market is strong and healthy when it's above both of these moving averages and when the 50 is above the 200. So we can see a couple of things breaking down, and the label in the corner pretty much says what it is. It's a 5-day change. It's asking, you know, what did this thing do in the last 5 days? So when the markets go down, they generally all go down. The question is, which ones are going down the least? And when they all go up, or when the markets go up, they all go up generally. And then the question is, which ones are going up the most? Your cyclicals or your staples or your quote safety stuff tends to go down less, but they also tend to go up less. They're just the boring, sleepy, defensive stuff, right? The thing is, the NASDAQ this week hasn't gone down as much if you look at its expected move as other things like, say, the S&P or finance. So we got a lot riding on tech at this point. And I would use weekly close and really take a good look at Microsoft, Apple, Google, Amazon, because they're the last straw at this point. Being underneath that 10-week, this is like a good reset point. We've hit that kind of, you know, the spot to turn around. And again, it's very likely that it won't happen this week. They'll let this week finish playing out, and then they'll start the turnaround next week. And we still need a catalyst. They'll put it into the narrative, right? Something will come into the narrative that will fuel that fire and bring the change for the move up. We can see the 10-year topped out. We actually got into that 4.3 this morning. That's crazy levels, but it is falling back a little bit. But something worth noting here, the dollar didn't fall back and hold the range. The dollar fell back and broke below my quarterly level. And US dollar Japan as well, it didn't just pull back and hold the high. It pulled back and broke that monthly level and is continuing to fall. So from US dollar Japan and from the Dixie, hey, things are looking good, right? We get this downward move. We should start seeing the S&P and the NASDAQ rally. The thing is, we're not seeing them rally. We're just seeing them not fall. That's a good start. But there's quite a bit of difference between not falling anymore and having a good rally back up. And I don't see the rally back up yet. So we got a good start. This 10-year is the change factor, right? This isn't selling off like these two are selling off. And until it starts to do that, you're not going to see that good, strong rally up here in the NASDAQ and the S&P. We need this. Without this sell-off, we can stop falling, but that's not going to equal a rally. Hopefully that makes sense, right? All right, so far things are looking pretty good. Bonds are turning around and 10-year is turning around, but bonds needs to break this Globex pivot point here and continue to move up, while the 10-year needs to break that lower pivot and continue to move down. It's all predicated at this point on these two. So you can watch the dollar, you can watch US dollar Japan, but they're making moves. And I mean, these are good size moves. You know what I normally say? We don't want to see fast moves, right? We want them going down, but we don't want it like tossing a brick in the water. It needs to be a nice, easy move to the downside. Well, these are moving pretty fast, and we're still not seeing anything. In fact, one of the reasons we might not be seeing anything is because it's so fast. So let's see that 10-year really start to respond. And then it's very likely we'll see the associated repercussions up here. Keep your eye on the clock. You got about 15 minutes for those job numbers. And then it's open window until what, 10 o'clock, I believe, to go back and look at the calendar. But, you know, it's the plan. It's very likely that none of these sectors or benchmarks that we would normally look at are going to have any impact, because again, waiting on those job numbers. But Bitcoin is down the most. The Bitcoin ETF BITO is down more than 2.25%. So leading everything to the downside, and then bonds, and then healthcare. Nat gas still a dog, but it's closer to zero than anything else. So we just kind of ignore that. On the other side, we got semiconductors, financials. Well, financials are below 50%, so never mind on them. Semiconductors, energy, building materials, and then a different kind of energy. This is exploration. While the ETF XLE is a broad-based energy, pretty much covers everything. XOP is more specific, oil and gas exploration. And then emerging markets, which ties in with the whole China thing. But it's interesting that we're not seeing, I guess we are. It's just hiding behind this little tab here. Let's try to get that out of the way. Get out the way, man. KWeb is there. I thought emerging markets, which has a lot of China in it, and then the KWeb, which is China's internet ETF. A different China ETF, which it's not internet, it's just the China ETF, is MCHI. I added that yesterday because the internet ETF for China doesn't necessarily represent all of China. That would be like saying XLK represents all of the US markets. I mean, kind of it does, but it doesn't, right? So yesterday I decided I needed a China ETF, and I'm using the iShares ETF MCHI. It gets the job done. And that's showing up as well, 3%, 2.3%. So the leading upward moving products today are going to be your China ADRs, BABA, Baidu, PDD, JD, very likely those ETFs for the EVs, Li, NEO, Ride. I'm saying that, but we haven't looked yet. So, it doesn't take much to just go take a peek. We can see Li with a strong gap up. NEO as well. Maybe swap over to things that aren't EV names. We got PDD here, a gap up. Baba. Yep. Baidu. Yeah, I mean, I'd be ashamed to that one, but yeah, okay. So it fits, right, with what we were just looking at. If you're targeting things today, you're going to want to target um, the China ADRs. One, they're down the most, right? Between semiconductors and tech and everything else, I'd say those China ADRs took a pretty solid gut punch in the last week. And I'd rather go long from something that's down the most than go long from something that's up the most. Talking about day trade stuff, right? Not swing trade and long-term stuff. When I'm hunting around in the morning for things that I might want to day trade, and we're seeing all of the market start to turn around and try to rebound off of that move from yesterday. And remember, we're just talking about a one-day move here. This rebound is very likely nothing more than mean reversion and a light bounce off of support. And we're going to go up maybe a day or two, and then we get the weekend. So not looking at, the recovery back out or any kind of language like that. China ADRs first. All of them, anything to do with China first, then energy, and then semiconductors. Now that can change if finance really does get in, or maybe one of these others like tech. We can see tech is far down at about uh, 0.25%. Finance is actually doing better than tech this morning. So either one of those could get into the game really fast. All we got to do is get these job numbers, and this could all just completely reshift itself. But at the moment, anything to do with China stuff, whether it's the EV names or their internet names, that would be my focus for long opportunities. Take profit along the way and be ready for things to change at a moment's notice, at least up into 11 o'clock, right? Or noon, honestly, because that 4-week auction, and it's the front end, right? That's what they control. So I would give it until noon. After that, there's really no shenanigans left. It would be more of, are there any speakers, and or is there any statements coming out? On a Thursday afternoon, I'm not expecting statements. They've gotten into the habit now of waiting until Friday after the close and then throwing statements at us if they have anything to throw, which I'm not anticipating. So what I got, guys, be careful, be safe, have a good day. I'll see you all tomorrow.